This took me a very long time to learn how to do. Investing in a smart way for your future does not. Warren Buffett's 8 rules for investing. I'm going to go over them in this video, and I'm going to do that while I'm completing this Rubik's Cube. And that's just because this Rubik's Cube is a lot more complicated than investing in the market, especially when you're following these principles. These principles make it really easy. There's all these people that are like trading with, and they're talking about candlesticks and dips, and they have all this complicated charts of what the stock was doing and what it's going to do. And you don't need to really do any of that if you're investing for the long term and you're just following these principles. And so I'm mixing this cube up right now so that you can see that this isn't, I don't have some like memorized pattern. I'm just gonna like figure it out while I'm talking about these 8 rules, right? And so first rule, number 1, okay, let's go ahead and get a little game plan together for this cube first. Okay, so number 1 is never lose money. And this seems pretty straightforward, right? Like, okay, don't lose money while you're investing. But the reason why this is even in here is a lot of people will go into a stock thinking, hey, I'm just going to put money into here and see what happens. And if I lose on this, it's okay. I'm only going to put a little bit of money in. The thing is, like, never plan for that, like ever. Always plan on every investment that you make is going to be one that you're going to make money in. And that way you'll treat it as such. You'll actually give it the importance that it deserves and do your due diligence. So that's rule number 1. And rule number 2 is never forget rule number 1. It's funny because even as I'm saying these rules, like I do this. I invested in the stock today because of stuff that was going on in the market and stuff with Iran and with Israel, and I was like, oh, this stock's going to go up. It was an oil stock. I don't know anything about oil. Like I haven't ever invested in that stuff. And I'm like, okay, as soon as I pulled the trigger and bought the stock, I was like, okay, this was stupid. Like I don't know that much about it. And I'm just guessing that it's going to go up, and I'm like betting that it's going to go up, and I'm okay if it doesn't. That breaks rule number 1 and rule number 2. Like I forgot about rule number 1. So never lose money. Rule number 2 is never forget rule number 1. So what's rule number 3? Rule number 3 is you pick a business, not stocks. So, and I'm sharing these because it's what I do now, right? What I tried to do. I'm not perfect. And so I never invest in a stock simply because of what the stock has been doing. Jack that up. Okay. So I never invest in a stock simply because of what the stock has been doing previously. I always want to understand the business behind the stock, because a stock price is just a reflection of a business that's operating. That's all a stock price is. And when you understand that, sometimes the price doesn't make sense when you look at the business. And maybe the price is way too low compared to how valuable you can see that the business actually is. That's a good stock to buy when you see that happening. That's what we want to look for. That's what we want. Sometimes it's the other way around. The stock price is way too high compared to what you see the business is. And so in that scenario, if you already own that stock, sell it. If you don't own it, definitely don't buy it. So we invest in, you pick a business, not stocks. That's rule number 3. Rule number 4, a wonderful company at a fair price is much better than a fair company at a wonderful price. So there's all these people, myself included, they used to get super excited about penny stocks. And maybe they weren't pennies, but they're like $2, $3, brand new company, just started. And I'm like, wow, like the growth potential in this is huge. Imagine if this gets up to one of those like stocks that's, $100 a share, $200 a share. Right now it's only $2. If the company's only been operating for like 3-4 years, chances are there's no way that it's a wonderful company yet. If it is, how would you know? You don't. You're just betting that it's going to grow into that. It's not a wonderful company. So it's much better to pick a wonderful company at a fair price than it is to pick a fair company that's like decent at like a wonderful price. That's why a lot of the stuff in my portfolio is like Tesla, Meta, Google, Amazon. These are all wonderful companies. I'm able to find them at fair prices. All right, hold on. I'm deep into it with this cube. What's going on? We're almost there. We're 2/3 of the way there. All right, let's switch it up a little bit. Okay. All right, so rule number 5, because you're not just here to see me do a Rubik's Cube, right? Maybe you are. Our favorite holding period is forever. So why do I bring this up? A lot of people want to like day trade stocks. They want to buy a stock thinking that the price is going to go up like tomorrow or the next day or next week. They're buying it specifically to be able to like hope that the price goes up and then sell it and make some money really quick. And I view that more like gambling than investing. It's all speculation. And I would much rather hold on to a company, like buy a company, because that's what you're doing. You're buying a company, not a stock, knowing that, okay, this is going to be, this company is going to grow, and so is the stock. Uh-oh, messed up again. It's a lot harder to do this while you're talking, but we're going to do it. I would much rather be able to buy a stock knowing that the company is going to grow, and that growth is what's really going to set me up in the future, not me guessing what the stock price is going to do. All right, we're almost there. Okay. So what are the remaining rules, right? So that was rule 5. Our favorite holding period is forever. If you buy a really good company that you know is going to do well, it's a great company, it's been operating for a long time, you know that it's just going to continue to do well, well, just hold on to it forever. Keep getting those gains. If you need to cash out, just get a loan against your stock instead of actually pull the money out. That way it continues to grow and compound in the future, and you continue to have this asset that is working for you, right? All right. Sweet. Okay, almost there. So, rule number 6, be willing to be different. Be willing to zig when others zag. But this is important. You kind of have to do your due diligence and understand the companies that you're investing in, because that's what they are. They're companies. They're not stocks. You have to understand them, because sometimes everybody will be making a certain decision on a stock, and they'll be doing it for a very justified reason. That makes sense. But if you understand the companies that you're investing in, and we're about to have this thing complete, if you understand the companies that you're investing in, and you see that everybody's taking a certain action towards a stock that doesn't make any sense, well, you know, like, okay, I need to zig, even though everybody else is zagging right now. And usually when that's the case, that's when you get the biggest gains. Don't be afraid to do that. Number 7, avoid credit card debt. You want compound interest working in your favor, not against you. Credit card debt has it working against you. Number 8, the last one, invest in what you understand. If you don't understand it, don't invest in it. When you follow these rules, it's a lot simpler to invest. This took me a very long time to learn how to do. Investing in a smart way for your future does not, if you follow these rules.